What is Dakota Research? It's a brand new user interface focused on helping due diligence analysts manage the enormous amount of information around private funds, new funds in the market, funds currently fundraising, all the Form D information around funds, Form ADV around fund of funds. There's so much information. We've built in CRM-like capabilities so you can enter in all the investments that you've made and you can follow those. That means anytime there's a change to that fund or that firm or portfolio manager leaves, you get an alert at 5 o'clock each day. You can enter all your investments, all your call notes, you can enter your proprietary contacts, you can enter anything you want, just like a normal CRM. Then you can run reports. You can run existing investment reports, and then you can run prospective investment reports because you can create opportunities against the funds that we have in the database. And if for some reason we don't have a fund in the database, you can add one. So it's basically a tool that allows you to manage the enormity of this information, of which we're doing 99% of the work, and we're just giving you a place to go view that information, read the information, and then enter your own information against that. You can enter contacts, you can enter accounts, you can enter funds, most of which we're already going to have. And then what we do in the background is attach all this additional information to those funds as time goes on. When there's news, when there's events that happen, it gets attached. So we're doing all that in the background for you. Then you can use this as the place where you view, track private fund information. As I said, new funds that are being formed, first closes, final closes, all that type of information without having to lift a finger or enter anything. The only thing you enter is you create opportunities, you can enter your call notes and your contacts. So if you want to book a demo, go to dakota.com and you can book a demo. It's an unbelievable platform. It'll save you so much time, and it also allow you to uncover new investment opportunities. Go check it out.
Hello, everyone, and welcome back to the show. You're still joined by myself, Pat Time, and I'm here with Alex DeMarco and Chris Leroy, who both lead our Dakota Research Investment Committee. Same format we'll cover today, where we'll go through private equity and private fund news and trends. We have some more updates from earnings season and some key big players making a lot of noise. Our deep dive topic, like I just mentioned, is going to be evergreen funds. So now we'll have done secondaries in episode 1. We did healthcare investing in episode 2, and now we'll have done evergreen funds. And then finally, we'll wrap it up with our insights and action segment. I'd like to keep that a little more miscellaneous. Stay tuned and figure out what we're going to be covering there. In the meantime, though, don't forget to like and subscribe to the podcast. We'll be available now on all podcasting platforms that you are familiar with. If you aren't already, check out the Fundraising News podcast if you haven't heard enough of my voice, and book a demo of Dakota Research. All the information that fuels this show, all the information that fuels Dakota is available to you in our platform. If you want to learn more, you can book a demo on our website. We make it very, very easy. Let's kick things off, though. Chris, you want to get us started on segment 1?
Sure, yeah. Last week was a busy week. We had earnings out from some of the big platform players, including Carlyle, TPG, Brookfield, GCM Grosvenor, all reporting earnings. We also had a series of investor conferences, too, as well. So one being the UBS Financial Services Conference, where Apollo and KKR presented amongst a host of other firms. We also had the Bank of America Financial Services Conference, where we heard from Blackstone and Blue Owl. A lot to digest after those. We hit some of the key highlights last week. So we've got a couple of follow-up items, particularly from Carlyle, that Alex will get to momentarily. This week, shorter schedule in terms of earnings releases. Digital Bridge Group, they are a infrastructure player, particularly within the data center space, reporting Q4 results on February 20th. Plus, we have several BDCs, Crescent Capital, Barings, that are reporting later this week as well. Maybe we could start with Carlyle, Alex. There's a couple of key trends, some points that they made in an earnings call, but also some recent news, too, as well, that came out of the firm.
Yeah, for sure. I would say 2 main areas of focus for Carlyle coming out of those events. One is their focus on the high net worth retail wealth channels, really trying to grow their presence there. Just a couple stats to point out. They're looking to grow their distribution workforce on the global wealth side by 50% this year, which is a massive investment, really banking on growing exposure of alts in the wealth space and high net worths and retail investors really wanting to tap in to the private markets, and Carlyle, among others as well, are really trying to get involved there. In the wealth market for Carlyle, they saw $4.5 billion of inflows, which is impressive, and I'm sure they're going to try to bolster that number significantly this year and moving forward. Not only do they want to grow their wealth presence in the U.S., but also in Europe. So they're actually launching a CCAV. Think of a CCAV as a mutual fund, but for Europe, for European clients. And that vehicle will be their Carlyle AlpInvest Private Markets Fund, which is a secondaries product, something we talked about a few weeks ago.
And AlpInvest being one of the larger platforms in the secondary space, Carlyle under their umbrella now. This vehicle definitely targeted at that wealth distribution channel and for investors. And just taking a look at the website too, about sort of how they're focusing the strategy. So about 35 to 60% secondary investments, 25 to 50% co-investments, more balanced with some cash holdings too, between 5 and 15%. And then primaries also being a part of the strategy, but lesser so, around 2.5% to 12.5%, and global too as well. So U.S. exposure being the largest, between 55 to 75%, and then Europe making up the balance, and also some rest of the world exposure there too. So interesting strategy to follow.
100%. It'll be fun to follow Carlyle and the other big mega funds, what they're doing to tap into those assets outside the typical institutions.
Yeah, what's interesting too on the headcount growth is that last year, we covered this on the Fundraising News podcast that we recorded today actually, but last year they actually grew their workforce just broadly by a third. So now doubling down on growing the distribution workforce by another 50%. Just continued growth, and these massive firms just getting bigger and bigger.
Yeah, it's becoming an asset gathering game right now, which is pretty wild because they're pretty big to begin with. So it'll be fun to follow. Another thing I want to call out too is Carlyle is definitely doubling down on their focus in their private equity. They are looking to launch their ninth vintage for their flagship buyout fund, Carlyle Partners. The predecessor fund, the Fund 8, closed at a little under $15 billion. And I think they're banking on more deal flow in 2025 and beyond, more fundraising activity, more investment activity, and really leaning on their private equity platform to bolster some additional fee revenue.
And this is second half 2025 development fundraise. So they'll be back in market later this year, already starting to talk to some of their core existing investors, I'm sure, but also some new investors too as well, with a large target, being just under $15 billion raised for Fund 8, it looks like. So likely to see a step up there too in fund size, just given the market growth and the size of the strategy.
Yeah, absolutely.
Another, not necessarily earnings related news, but also some interesting news that came out of a firm that reported at the end of last week called Flat Capital. I think this is actually a firm that I had no idea about prior to putting the podcast together with the team. And it was just really interesting to focus on this firm because there's a kind of intersection between both private markets and public markets here. Flat Capital being a publicly traded firm based in Stockholm, where they are backing leading growth firms, OpenAI, Klarna, Instabee, SpaceX. They have investments in all of these firms, which is so interesting. They reported last week, but they have this unique approach where they don't take board seats. They like to stake investments in some of the most interesting dynamic companies out there today, but basically think very long term and use the capital base in the public markets to raise capital to make these investments. And we'll pull up a slide in a little bit here, just talking about where some of the current investments are, the descriptions of these firms, and the years they invested with them. Just a couple of things to kind of call out too. This firm is listed on the First North Growth Market, which is part of NASDAQ. This is something that was designed for small and mid-sized growth companies, offers easier listing process that the main NASDAQ market does not have currently, with lighter regulations and lower financial requirements, making a popular choice for early stage companies to seek public funding. So a really interesting firm to call out. The firm's two key individuals leading it, Hannah Andrian, and also the former CEO, Sophia Benz, and Klarna CEO, Sebastian Siemiatowski. Hope I got that okay. But both leading the charge there. And a lot of AI-focused investments too. XAI, OpenAI, Perplexity, all investments that these firms are made. So just kind of a cool firm to keep a track of and call out there. Maybe we could pivot from there. Also some interesting news coming out of the World Health Organization. them announcing that they're exploring a $50 billion endowment fund. Why this could be interesting is because we're seeing a lot of different changes at the federal level. So federal funding changing, who's sort of stepping up to replace where this funding was coming from before, if the federal government's stepping back. The World Health Organization sounds like they're trying to get a little bit ahead of that to establish maybe a more perpetual endowment style fund to help meet their operating expenses, meet their requirements. And they mentioned in the article too about the Wellcome Trust, which is a large notable trust that's been innovative and stepped up. So they back both private capital funds. And I'm just curious to see if this is something that we see more of, where you see private capital stepping into where government capital was before. They think the fund could generate about $2.5 billion annually. And something that's not necessarily set in stone yet, but also something they might consider investing in equities, venture capital, hedge funds, and the like. Just something that our team picked up I thought was interesting. Maybe we'll start to see more of this. We're at the intersection of private and public funding, and more private funding stepping in to fill the gap.
Yeah, speaking of funding, though, our next segment here, the fundraising highlights segment, we'll all talk a little bit here on funds that are whether recently closed or recently in the market. I'll go ahead and kick it off. You guys are talking a lot. Quadrilla Capital, their AUM has topped $500 million following the close of their Fund 2. That is an enterprise software investment firm. Quadrilla is based in Santa Barbara, California, an area we don't hear about a ton. You hear a lot about San Francisco, you hear a lot about Newport Beach, but Santa Barbara is sort of right there in that central Cal, kind of no man's land. Very exciting. Actually, had a chance to visit Santa Barbara recently, and it's quite lovely. So if anyone's listening in, if you get a chance to go and visit Quadrilla, I'd highly recommend it. The fund received commitments totaling $300 million from 33 investors as of January 10th. So again, they are going to just keep growing and growing and growing, and that tops that firm AUM at $500 million.
And they're investing in SaaS businesses targeting annual recurring revenue between $8 million to $28 million range, the earlier stage investments.
Yeah. Alex, you've got an update here from a much larger firm, to say the least.
Yes, Oaktree Capital Management. They manage approximately $143 billion in assets. Massive player in the private credit space and just private markets in general. They were recently acquired by Brookfield, I believe. I don't know if that was a year or two ago, but fairly recently. So they raised a record $16 billion for their distressed debt fund. That is their 12th vintage. They secured investments from some big institutions, including the Virginia Retirement System, Connecticut Retirement Plans and Trust Funds. Those were some of the big public pensions investing in this strategy. This is just part of Oaktree's just global opportunity strategy. They have credit investment vehicles across all sorts of different credit strategies. They're just continuing to become one of the key players in the private credit world, and I can totally imagine that their acquisition by Brookfield is definitely helping them expand their investor base a little bit more.
Yeah, I mean, this is Howard Marks, one of the early strategies that Oaktree launched, and is designed to be super flexible. So when you think about the credit environment today, you think about base rates being higher, you think about just being the cost of capital going up, what that really means for businesses seeking financing. And it's not just necessarily direct loans, but there's also other being a capital solutions provider to these businesses. Also, when you think about sort of different rolling paces of growth across different industries, Oaktree can step in to provide, flexible financing solutions, liquid credit, rescue financing, can also do some distressed debt oriented investments out of this strategy as well. So one to continue to track, but longstanding position within the marketplace, and at this size too, it gives them the ability to kind of both lend to large organizations, but also nimble enough to find interesting opportunities to further down the capital structure. Rounding out the fundraising highlights too, we call out Northrum Horizon. They closed their third flagship fund at $235 million. Fund 3 hit their hard cap. Strong investor demand. The firm acquires and operates well-run, profitable service and software businesses. In line with this strategy, Fund 3 will target well-managed lower middle market companies with established platforms in the area of business and consumer services, healthcare services, software and tech-enabled services. It focuses on companies with EBITDA in the $1 million to $5 million range, just on the smaller end, but a relatively newer firm, also one that maybe not everyone also often hears about. They've made a couple of investments more recently in Genesis Landscape Solutions, Horizon Commercial Pools, Noble Hospice, North Star Preschools, Total Apartment Solutions, just to name a few. We're going to kick it over to deal activity shortly, but just a kind of a interesting group of funds kind of closing there.
Yeah, I think we're finding more and more through our research, using the Dakota Research engine and other sources, that these lower middle market buyout firms are really starting to raise some pretty significant capital only on just their second or third vintage, which is pretty impressive. There's definitely much more of an appetite for LPs and investors to invest in sort of the lower middle market. It seems to be the hot place to be.
Absolutely.
Cool. Kicking off the deal announcements, we'll stick on the smaller end of middle market. Alex, we'll let you talk about this. This is a company that you've actually used that has been involved in some deal activity.
Sure, yeah. So Wall Street Prep, which is a training company that works with large financial institutions to train their new workforce on anything related to finance, whether it's financial modeling or capital structure, what have you. They were just bought out by the Riverside company. They acquired Wall Street Prep from Eden Capital, which is a firm that Chris actually just spoke to recently in the studio, which will be coming to you shortly, hopefully. This is a really interesting one, particularly, Riverside spoke to it in the press release and just where they're focused. They invest a lot in the education and corporate training space, and they really see that as a growing area. Some stats on Wall Street Prep. They have more than 300 corporate clients, 150 university partners, and 500,000 learners on the platform using their content. Eden Capital, who sold the business to Riverside, they bought it initially in 2021. Wall Street Prep, again, I used it when I was a first-time analyst in my previous life. Super helpful, super rich content, and really is a super important tool for people coming out of college looking to get a more holistic background in financial markets, maybe something that colleges or classes and college curriculum don't really teach super thoroughly. It was very helpful for me to get that taste going into the workforce for the first time.
And think about all the theory and you're kind of deep in the books and things like that, but then you think about the platform itself. It's just right out of the gates. What am I doing? Give me some practical skills and that training tools to be able to enhance both graduate and ongoing professional development, but also being able to take something and do it and then translate it right to your work environment. It's like super helpful too.
Yeah, Wall Street Prep will provide users with self-guided content that you can go on with as you please, whether if you're before you even started a company, they'll give it to you. When I used it, it was part of a program when you started, so you were with all of the other people in your analyst class. There was actual teacher walking through the assignments. It was extremely helpful, very thorough and really intense, but you can just see all these banks are starting to leverage these kind of tools a little bit more to make sure that their analysts are coming in for the first time, ready to hit the ground running.
Yeah. Would you call this like an ed tech play out of Riverside, or what sort of bucket does WSP fall into?
Sure. Yeah. I think that's right. Eden Capital, speaking with their team, really, when they invest at very early stages of WIC business. So it's founder-led businesses, in the education space where they are really trying to formalize and enhance their platform. So one of the things that Eden did while under their ownership was really institutionalize that business. And when you think about Riverside and the scale of their private equity platform, it allows them to take Wall Street Prep and expand it in a lot of different ways. It also just has Riverside's a global company too as well. So you think about probably expanding kind of the TAM for that business. They have a lot of capabilities that they can lever. Blackstone Life Sciences also was in the news recently. I thought this article really jumped out too. Their investment, Anthos Therapeutics, was being acquired by Novartis for up to $3.1 billion. This is speaking kind of to the trend of where you have large strategics acquiring newer life science businesses to expand or broaden their patent portfolio as more firms are kind of looking for patents to enhance their portfolio that are expiring. The company is a transformative clinical stage biopharmaceutical company developing innovative therapies for the treatment of cardiometabolic diseases.
Yeah, large deal for sure, and sort of a nice follow-up to our discussion last week around in depth on healthcare investing. So if you're interested in that deal and more and what fund managers are active in that space, definitely go and check out the recording to last week's episode.
Absolutely. Diamondback Energy was also in the news recently. Diamondback's a public energy company focused in the Permian Basin. I don't know if any of you guys have been watching Landman. I certainly have. That is, great show, but also an active area for investment right now. Diamondback's announced plans to acquire Double Eagle Energy in a cash and stock deal valued at approximately $4.1 billion. This move aims to enhance Diamondback's presence in the Permian Basin, adding about 40,000 acres in the core Midland Basin specifically. It's expected to close April 1st, 2025, subject to regulatory approval. Double Eagle was a business owned by NCAP Energy, which is a large player in the space, but a lot of activity going down in the patch.
Yeah, haven't been watching Landman, but White Lotus is back, so that's going to be taking up the entirety of my brainwaves.
White Lotus on Severance, just
I know the time it's out of control. But we've got a people moved call out here too. I'll just take this one. Per Franzen has taken the helm at EQT. EQT, obviously, large private equity firm, and now they've named a new CEO. Again, he's sort of no stranger to big moves. He had been with them for quite some time now. He had been integral in raising their largest ever fundraise, which was EQT Fund 10. We covered that actually on the Fundraising News podcast and in depth in Dakota Marketplace and Dakota Research with the LP rosters. And it's interesting. EQT, like the rest of these really large firms that we mentioned, are all sort of gearing up for just huge fundraising efforts across a variety of
100 billion euros seems like the target they've set.
100 billion is out of control, and just with new leadership at the helm, why not?
Yeah, they're really trying to be a solutions provider as well. Like the Apollos and Carlyles of the world, they acquired Extra Group, which is a real estate firm based right down the street from us in Radnor. So they're really trying to offer a suite of investment products outside of just their sort of flagship private equity strategies.
And Christian Sinding, who per Franzen's stepping into his role, he's moving into a institutional partner role. So staying with the firm, but just kind of a continuation of the same, but bringing in new leadership too.
Yeah, it's almost like a tag team effort now because he'll still be chairing the strategic committee, it seems like.
Yep.
Cool. That'll wrap up our first segment of the day. We will jump right into our deep dive topic. As we mentioned, this week's episode will focus on evergreen funds. We're talking a ton about them. There's more and more of them launching at all times. There's a lot of different nuances in this asset class. It's no doubt something that's really, really interesting for wealth investors. And as we've talked about already in our opening comments today, that continues to be an area where large firms are doubling down. So I'll hand it over to you guys. Alex, want to just kick us off?
Yeah, so evergreen funds, a very quickly growing investment vehicle. I think Chris and I were just speaking about it earlier. The AUM of evergreen funds in totality is around 400 billion, which is quadrupled in how long?
AUM is now approaching over $400 billion and it's quadrupled. And the number of evergreen funds in the market today continues to proliferate. We're talking about the AlpInvest fund, the ICAV fund too in Europe that Carlyle's, just launching now too as well. Just like you see tons of new funds being raised each day in the space.
And we're going to talk a little bit more later about why this investment vehicle is growing so much. But just to really highlight what we're going to talk about today, it's just at a high level, what are evergreen funds? You might be wondering what they are. So evergreen funds are an open-ended private fund. So if you think of a traditional drawdown fund, LP investment vehicle, where there's a first close and a final close, and there is a fixed term to the investment vehicle. So they might be investing out of it for 10 years or 12 years or 7 years. These are accepting inflows and providing outflows continuously. So there's no fixed termination date. So like I was saying, unlike a traditional closed-end private equity fund where there might be a defined investment period, these are operating indefinitely. So a couple of key characteristics I want to highlight on evergreen funds. So like I said, there's no fixed life. Capital is constantly coming into the fund and exiting. And what's nice about that is investors can redeem capital a lot more frequently, so they don't have to wait until the funds close to get distributions back. There might be some holding periods and quarterly liquidity. You can't, pull out money every day, but it is a great way to, especially for the high net worth community, to get access to private markets, but not necessarily put their money in a fund and wait 10, 15 years and then start seeing distributions. This is a way it's a more liquid fashion of the private markets, which is, as we'll talk about later, becoming really attractive for not only the wealth channels as well, but institutional clients as well.
Yeah. Evergreen funds too, very similar to nuances, but kind of like a REITs basically, where you have these underlying illiquid asset classes in a more liquid share with the appropriate terms and features around it to allow investors to access parts of the market that are non-traded. There's kind of key differences too, though, between sort of the traditional closed-end drawdown funds that private equity funds are known for, but evergreen funds as well. From a fund structure, you talked about it being perpetually offered. So these are always in market, always available to add capital to. So when I think of wealth advisors or family offices you need to put capital to work more efficiently, monthly subscriptions. So it's not necessarily waiting for a fund to come back to market to make a commitment like you would in a closed-end fund. Term, you mentioned there's no sort of fixed end date, which is great, versus a closed-end fund where you have 10-year life. And then you have the investor suitability too. Closed-end funds typically have to have $5 million in net worth, qualified purchasers, whereas in evergreen funds, these are suitable for accredited investors and qualified clients, so different asset level to be able to invest. The other thing I would just call out too is sort of the simplicity in the tax reporting. So everyone's very familiar with the K-1s with private investments. Those are tax forms that are, typically they can be delayed. Sometimes there's some pluses and minuses to those, but for evergreen funds are 1099. So they come in very efficiently, almost like they would for your stocks or bonds and your Fidelity account reporting. And then from a capital call perspective, there's no capital calls.
Yeah.
So when you think about, okay, how much do I get called? When's it going to called? It's you put all your money in and it gets invested right off the bat. So that's a big plus. And then you think about minimums. Evergreen funds too are sort of lower barrier in that sense, where you have $10,000, $25,000 minimums, which are much different than closed-end funds, where you talk about some of the larger funds accepting $5 million, $10 million at a minimum just to get invested.
100%. Definitely want to touch on why investors like evergreen funds so much.
Yeah.
Again, you just touched on it, but just a very simplified capital commitment model. You invest, there's no capital calls. So when an underlying holding might appreciate in value, they'll just reinvest those earnings. So you don't need to wait for the GP to call more capital, invest more. You put in your money and then you can wipe your hands, and then it's also very simple to exit too. There might be some sort of holding period, but you can get in and out of these evergreen funds relatively nimbly relative to a traditional closed-end private equity fund. Another advantage of evergreen funds is the lack of vintage year risk. So these funds, since they're evergreen, they're perpetually in market. They're investing across market cycles. So, if you invested into a buyout fund in 2007, right before the Great Recession, you probably didn't have the best returns. But in an evergreen fund, you're investing across multiple market cycles that last 5 or so years, 7 or so years. So it reduces that risk of investing in a certain time period where there might be a recessionary environment where there might be not a lot of deal flow and exit activity, which I think people really appreciate.
When I hear evergreen funds too, and one of the things we wanted to call out in this segment was really just about, we hear about this name all the time, but like, what really are they? So there's a whole proliferation of funds, and they come in all different shapes and sizes, and some of they're offered by some of the largest investors, but then there's also some firms that offer evergreen funds that are, firms we've never heard of or new entrants to the business. And then there's also partnership models too as well. But we're hoping to break down and get a little bit more granular on the different types of evergreen funds that exist today. We start out by discussing business development companies, or BDCs, that people are very familiar with today. These are SEC-registered closed-end funds that focus on private credit, including making middle market loans, direct investing, and mezzanine debt. These were initially designed to support small and mid-sized businesses, but have evolved into a major lending vehicle or solution. There are two types of BDCs to call out. Publicly traded BDCs, which are some of the ones that we mentioned earlier. They're listed on exchange. They allow for daily liquidity. And they're non-traded perpetual BDCs, which function as evergreen private credit vehicles with periodic liquidity. BDCs primarily invest in senior secured loans, subordinated debt, and equity stakes in private companies. And a couple of examples just to put a little bit more illustration to this. Blackstone Private Credit, or BCRED, is one example of a BDC. It's one of the largest perpetual BDCs, and they focus on senior secured loans to large U.S. companies. The other type of evergreen fund are interval funds. These are SEC-registered closed-end funds that, under the Investment Company Act of 1940, 40 Act funds. Unlike mutual funds, interval funds do not trade on an exchange. Investors buy directly from the fund and can only redeem at design intervals, such as quarterly. They can hold liquid assets, so making them popular for investment in private credit, real estate, alternative assets, such as structured credit, asset-based lending. They also provide structured periodic liquidity, so while still offering exposure to longer-term private investments. Cliffwater has a Cliffwater Enhanced Lending Fund, which invests opportunistically in private debt, direct lending, structured credit, and real estate, is one of the larger funds in the space. The other type of evergreen fund are tender offer funds. Tender offer funds are private market investment vehicles offering periodic liquidity via repurchase offers, typically quarterly or semi-annually. Unlike interval funds, tender offer funds are not required to be repurchased a minimum amount of shares, meaning managers can limit or deny redemptions based on liquidity constraints. So when you think about sort of managing more liquid share class with an underlying more illiquid investment, these types of terms help better align investors with the underlying investments themselves. Tender offer funds typically invest in private equity, both direct and secondary investments, private credit, think direct lending, structured credit, distressed debt, and real estate. So these are things like core, value add, opportunistic strategies, both from sort of established real estate to new development type real estate. Tender offer funds are used by investors seeking private market exposure with some liquidity flexibility through redemptions, subject to fund restrictions. And one group to call out, or investment firm to call out, Partners Group, private equity firm. This invests direct in private equity deals, as well as secondary LP interest, offering exposure to a diversified global PE portfolio. Now, we talked about a couple of the large funds too, but Alex, maybe you could walk us through a little bit about the key drivers, what this growth means.
Yeah, absolutely. So I touched on it a little bit earlier, but the main driver is the demand from the private wealth space. So high net worth individuals, retail investors, RIAs, and family offices, where they want exposure to private markets, but they want something in more of a liquid fashion, and they want the lower minimums. This is the product for them. And again, not only do retail and high net worth investors want this kind of investment vehicle, you can speak this as well, coming from sort of more of an institutional allocator seat. Those larger institutions like stuff like this as well, because they can seek sort of yield-driven alternatives to fixed income.
Absolutely.
And just regulatory tailwinds as well. So SEC and global regulators are easing access for retail investors into private markets. And I think one thing to point out too is just there's no lack of transparency around these products, whether they're traded on an exchange or they're a 40 Act fund. They're required to provide quarterly reports, prospectus language, performance, net asset value, anything that you would find on your typical ETF or your SPY or QQQ. You're going to get all that same information for one of these strategies. So as an investor, it's really easy to educate yourself on what the strategy is investing in and what the peer investment funds are doing as well.
And we're covering it on the platform in Dakota Research too. The funds that we have, they're in the market by asset class, just given the sheer growth of the market here too. And you mentioned just the interest in these types of investments as well. When I think about, put myself in sort of the advisor seat, and I think about, okay, I'm transacting, I'm realizing capital gains or losses at the end of the year, I'm investing in new private investments, like how to manage all of that versus sort of a traditional closed-end fund. You don't necessarily have, how much cash am I reserving? What are sort of my underlying investments in the fund, the transparency there. It's being able to go to their website, find more information about those funds, see what kind of investments they've made, the team, how they orient themselves, what specifically do they invest in, and then be able to have the reporting requirements around that. Also the tax reporting from 1099 perspective, just a lot more efficient way to get exposure to more illiquid asset classes in a liquid format. So it makes sense why we've seen the rapid development of this asset class and continue to see new funds launch every day. It's very it's a tall task to keep track of it all, and that's why we're trying to make that simplified for individuals out there that are looking for exposure there.
And going back to what we were talking about earlier on the podcast with Carlisle trying to grow their presence in the retail and wealth channels. If people want it, someone's going to build it. And these firms, the KKRs, the Blackstones, the Blue Owls, these massive investment firms are wanting to get into the retail and wealth channels because that's sort of historically an untapped pool of capital. One way to do it is develop these evergreen funds that they want. So that has been a key trend and a big driver for the adoption of these funds.
Absolutely.
Yeah, and if you want to learn more about evergreen funds, what are some resources? Where can folks go? In Dakota Marketplace and Dakota Research with 13F filings, right? Certain evergreen funds, namely public BDCs and interval funds, are going to be filed in the 13Fs. But what are some other resources folks can use to learn more about these?
Yeah, sure. I mean, absolutely. At Dakota Research, we have coverage on funds, some of the largest evergreen funds that are out there currently available to folks, what they do, what they invest in. So we're trying to add the qualitative commentary to the strategies so people can better understand how they make investments and what they do within the market in this ever-growing space.
I love it. And then a lot of these large firms have education on their website too. Stepstone is one, friend of Dakota's, want to give them a call out, that is. But they have a ton of resources on their website that are, free and public educational resources. I'm sure Wall Street Prep, who you mentioned a little while ago, may have some resources for folks to learn more. Yeah. But of course, you can obviously check out Dakota Research for any of that. But let's just kick over to the last segment then, which will be our funds in the market today. You'll start us off with BC Partners, Chris, and then Alex will talk Waterfall Asset Management, and then I've got a sort of a special corporate venture fund I'll wrap us up with.
Excellent. Yeah, thanks, Pat. BC Partners targets a $6 billion raise for their 12th flagship fund. It's a British private equity fund aiming to raise $6 billion. The predecessor fund, BC Partners 11, raised about $7.1 billion US when it closed in 2022. The flagship fund has secured commitments from California State Teachers Retirement System, City of New York, State Teachers Retirement System of Ohio, Alfred Sloan Foundation, to name a few. Under the private equity strategy, BC Partners raised 11 successive funds that attracted over $30 billion or $31 billion US in total commitments. I've now made about 128 investments in 19 countries, so global. Wow. And a focus on businesses in Europe and North America with enterprise values surpassing $300 million.
Yeah, and I'll touch on Waterfall Asset Management. They are aiming to raise $750 million for a new fund for them, focusing on asset-backed credit opportunities. This was filed with the SEC on the 7th of February. Waterfall is a pretty niche credit player based in New York. They focus on specialty finance opportunities, whether it's performing or non-performing loans, CLOs, asset-backed securities, commercial mortgage REITs. That's sort of the area where they play. Some of their LPs and their other funds and strategies to call out, Maryland State Retirement and Pension System, New Mexico Educational Retirement Board, the LA County Employees Retirement Association, among others. That's coming from Dakota data. This is a strategy to follow to the first strategy for them, but they're pretty strong players in the credit market to begin with, so they should have plenty of success making that fundraise, and the firm is currently at $13 billion today.
Awesome.
Yeah, I'll wrap us up with something a little different. This isn't the type of fund we typically cover, but want to make sure we are broadening just the type of information we're covering. So Thomson Reuters, you heard that right, not an investment firm necessarily, but they do have a corporate venture capital fund. It's Thomson Reuters Ventures. They have announced that they will be launching the second vintage of this fund. They're targeting $150 million. The fund follows their predecessor, which had $100 million and launched back in 2021, so just 4 years ago, and they're back in the market with the second here. no shock based on who they are and what they do. They're targeting early stage technology companies across legal tech, tax, accounting, financial technology, risk, fraud, compliance, news, and media. Investments from the first fund, they had a 23 company portfolio, including companies like Spellbook, Materia, Payout, Legible, Redbird, Northstar, a company called Tags, and then Notica. Actually, I've heard of Legible and Payout as just different service providers that serve sort of financial services. This fund is going to be a lot larger, and again, they are still going to be focused on Series A investments, but now they will have the additional size, the flexibility to explore even earlier and later stage opportunities.
Pretty interesting. I mean, a lot of companies have corporate venture arms, but they tend to invest off their own balance sheet. So interesting they're raising outside capital for this one.
We've got a lot of upcoming Dakota events, new product releases too that we'd like to call out too while we have you.
Yeah, absolutely. New product releases. So if you all been following along with this show and everything else that we are doing, Dakota Research is now live and up and running, has been now for over a month. We've added a ton of really, really cool features. One huge one to call out is the introduction of the fund memos that you guys are writing. Why don't you talk just a little bit about those?
Absolutely. And so when I think about being a due diligence analyst and looking at private funds, I haven't found the perfect solution yet for where you have both data, both the raw numbers, and then also you have the qualitative information too right at your fingertips. And being able to quickly vet and say this is a no or no go quickly is such a powerful thing, and you can save time that way. So what we've built here is really a qualitative view of what a firm does, who the people are, the types of investments they make, and distill that down very simply so you can basically get to a 1 to 200 level understanding of what a firm does and don't have to spend a lot of time searching or spending time on more calls than are necessary if it's a strategy that doesn't fit perfectly. We also include investment criteria, revenue ranges, you name it. So there's a lot there.
Yeah, and what's exciting too is as you're making those decisions and using the data to form your own opinions about these different funds and firms, we've now incorporated a ton of what we'll call workflow or CRM-like tools into the platform. So you can now keep track of potential investment opportunities. You can create a portfolio within the platform and say, hey, here's 4 firms that we've invested with. Here's 4 firms that we're diligencing now. Here's 4 firms we're in early stage conversations with. You can track your meetings with those firms. Okay, hey, last month I met with 10 firms. 2 of them were now doing, deeper dive due diligence on.
And we're doing all the back end work too, for you. So it's not necessarily you have to keep all those records right. I mean, if there are funds and strategies that you want to include and have specific line items that you want to put in there, we allow you to do that too, or we can help you do that. But in terms of all the data upkeep, the people moves, performance, all those things, and the new funds coming to market, that's something that we're doing. We're taking the lift off of you.
Yeah, it's a ton of information and it's really, really hard to keep track of. So you all listening to this show, you shouldn't have to. We'll do it for you. You can just keep track of all your notes built in on the platform, which is really exciting. We're on the road, guys. We have a lot of upcoming events. If you're listening to this on Friday, the 21st of February or after, the New York event we're hosting on the 25th is full and has moved to a waiting list. We'd love to have you at the next New York event. You can reach out now. We can get you on an advanced waiting list for that. We had Dallas on February 26th, Boston on March 5th.
Out to Park City.
And then we're headed out to Park City. We will be on the slopes on March 20th. And then we'll be at the Spur in Park City for a cocktail hour afterwards. We'd love to have you all. You can go to our website, Dakota Cocktails, and you can find all of that information to register.
We're also hosting the weekly webinars, continuing the series there. So folks can come in, learn more about current product updates like we discussed, also get a better feel for the platform, and also a way to kind of book demos with Dakota Research to learn more.
Yeah, those go live as well. So you guys can, in the crowd, can ask questions. We'll answer them on demand.
Yep. Yeah, absolutely. And maybe we could also tease too. We're going to launch in a few months the Dakota Research Investor Conference too as well.
Yeah.
It's really exciting. So there'll be an allocator event where they can come and hear from funds that are currently in market, learn more about their investment strategies in New York. So it's exciting and more to come there.
Yeah, and get the chance to meet us.
Yes.
Well, good. That'll wrap it up for us today. Again, we thank everyone for listening in. It's been a lot of fun these past 3 weeks. We look forward to a lot more. If you have any feedback on what our next deep dives should be for our topic segment, let us know. Next week, we will talk about infrastructure and probably mix in some real assets too.
Excellent. We look forward to it. Yeah.
Great. Thanks, guys. See you next week.